Today we're discussing revenue, an area that affects virtually every company out there. Specifically, we'll discuss some of the considerations for companies preparing for the adoption of the new revenue standard. With me are Dusty Stallings and Michele Marino. Dusty is a partner in our accounting advisory practice and is actively engaged with companies as they navigate the implementation of the new revenue standard. Michele is a senior manager in our national office, focused on various activities related to the new standard, including offering publications, developing training material, and consulting with teams on implementation questions. Dusty, maybe I'll start with you. I know that the effective date was pushed off a year, but I would like to think companies are pretty much well into their implementation, or at least have a plan to do so. Is that what we're seeing?
Well, actually, we're seeing quite a mix, and both within industries and across industries. So, some companies don't even have a plan in place at this point to determine how they're going to assess how this standard affects them. It's a lot of effort, both in terms of the process you need to go through, as well as the time that it's going to take in order to validate what you believe is going to happen as a result of this standard. So, for example, in terms of changes, we've seen a lot of companies surprised by the amount of change that they have around identifying performance obligations and accounting for variable consideration.
So you mentioned performance obligations. I know that that was discussed by the Transition Resource Group. That's the group that discusses implementation questions that inform the FASB and ISB deliberations. Michele, can you take us through what the clarification was that they issued on performance obligations?
Sure, Val. So performance obligations are the unit of account that's used to apply the new revenue model, similar to what we'd call a deliverable today. The new guidance includes criteria and a list of indicators that help companies determine when goods and services are distinct, meaning they should be accounted for separately, and when they should be combined into a single performance obligation. Now, this is somewhat different from the concept of standalone value that we use today. So while companies can look at the overall principle in the standard and this list of indicators, the assessment is still going to require judgment, and the conclusion is going to be based on the facts and circumstances of each arrangement.
Yeah, so I think the key takeaway here really is that the guidance is different. So companies may end up having more performance obligations than they had in the past. They may have fewer performance obligations than in the past. But in any event, you've got to put in place the controls, the processes, and maybe even make system changes to be able to account for those differences if it is different from what you do today.
All right, that's helpful. The other area you mentioned was variable consideration. Michele, what kind of challenges or changes will people see in that area?
So first, I'll say that the concept of variable consideration isn't entirely new. Things like price concessions, rebates, performance bonuses, contingent fees, those would all be examples of variable consideration. Consideration can be variable whenever an entity doesn't know the exact amount that it's going to be entitled to. So today we have this requirement for revenue amounts to be fixed or determinable. And so sometimes companies have to defer revenue recognition for variable fees until they're either received or earned. Under the new standard, though, companies will need to estimate variable consideration and include it in the transaction price. So in some cases, you might end up with accounting that is similar to current practice, but in other cases, companies are going to need to make new estimates that weren't required today, or they might end up recognizing revenue related to these variable fees earlier than they do today.
Okay, so I can see why companies may not know if that's going to impact them until they're into the implementation. And Dusty, you mentioned that not everyone is well into the implementation. So what's your advice if companies during their process come up with new issues?
Well, we still have the Transition Resource Group. They're going to continue to address implementation issues as long as a sufficient number of issues are raised. So if companies do have implementation issues or questions as they go through their process, certainly it would be a good idea to get them to either the TRG or to the FASB as timely as possible. It's also helpful for companies to go back and take a look at the papers and the minutes of the prior TRG meetings. Not all of the topics that were discussed resulted in changes in the standard itself. A lot of those topics were discussed. There was a lot of good thinking around how the members would view it and how they would view the implementation of it. But they didn't change the standard, so there is some really good information there for companies to look to.
So even the discussion may help them out?
Absolutely.
Okay, so maybe let's switch to the actual implementation. I know that there are two different means by which you can adopt the standard. Michele, can you take us through those?
That's right. Companies can choose from two different transition alternatives, what's called a full retrospective method or a modified retrospective method. Under the full retrospective approach, a company would recast its prior period financial statements as if this new guidance had always existed. So for example, a company would recast its 2016 and 2017 financial statements if it had adopted in 2018. The modified retrospective approach, on the other hand, provides companies with some relief because they don't need to recast prior period financial statements. Instead, a company would record the cumulative effect of initially applying the new guidance as an adjustment to opening retained earnings in the year of adoption, so in 2018 in my example.
Okay, so Dusty, in your experience, are companies leaning one way or the other?
Well, again, this is an area where companies are quite mixed in what they're doing. Both methods have pros and cons to them. If you do the full retrospective method, you've got great comparability, so it's certainly going to be appealing to a lot of analysts and investors. That said, there's a lot of effort that goes into dual reporting for a 2-year period, the 2 comparable periods, so it is going to be important that companies make sure they have the resources available to do that if that's going to be the path that they choose. Now, the modified retrospective approach, it sounds easier. You don't have to do a report for 2 years, you just do a report for the 1 year, but you're doing it all in the year of transition. And there are a lot of additional disclosures that are required as well. Basically, what would these numbers look like if we'd continued on under old GAAP?
So, Dusty, you mentioned that part of the decision is based on the availability of resources. The leasing standard just out, another pervasive standard that's going to have broad-based impact. Is it a concern that companies are going to be trying to adopt both standards at the same time?
Well, it certainly can be a concern if you haven't planned accordingly. As you say, these are 2 significant standards, and there's no question that for some period of time, these 2 projects are going to overlap. So as companies are determining how they're going to go about implementing these standards, they do need to consider, do you have the resources, do you have the bandwidth to do this yourself? Or if you don't have enough bandwidth and resources to do this concurrently, do you need to hurry up and try to get as much of revenue done as you can so that you have more time to devote to leasing in the futures?
That's good advice. Obviously, there's a lot we could cover here. Maybe if each of you could give me some key takeaways.
Sure. Well, first I'd say that companies really need to be educating their organizations internally, and this should really extend beyond the accounting department because this is much more than just an accounting change. So individuals from sales, legal, tax, HR, IT, they should all be involved in this process.
And I'd say the most important takeaway is get a plan in place and get started. Even if you don't believe you're going to have any changes, there's a lot of work that has to be done in order to prove that that's the case. And if you do have a number of changes, you're going to need sufficient time to build in what you need in your systems, to build the controls around it so that you can get this number right, because it's revenue, it's important.
That's great advice. I appreciate both of you being here. Thank you very much. For more information, refer to our revenue page on cfodirect.com.